The 1980s witnessed Japan's spectacular economic rise. Following its defeat in World War II, the nation had transformed itself into an industrial powerhouse. Japanese companies known for their quality and innovation dominated global markets in electronics, automobiles, and technology. The period from 1945 to 1990, known as the Japanese economic miracle, saw unprecedented growth and prosperity. Japan's success was attributed to its unique economic model, characterized by close collaboration between the government, banks, and corporations. This era of rapid growth and innovation led to significant wealth accumulation in Japan. The stock market soared, with the Nikkei index reaching unprecedented heights. Real estate prices skyrocketed, particularly in major cities like Tokyo. The economic boom created a sense of euphoria and invincibility, leading many to believe that Japan's prosperity would continue indefinitely. However, beneath the surface of this economic miracle, a dangerous bubble was inflating, setting the stage for a dramatic fall. Several factors contributed to the formation of Japan's asset bubble in the 1980s. First, the Bank of Japan's loose monetary policy, aimed at stimulating economic growth and combating the yen's appreciation after the 1985 Plaza Accord, resulted in excessively low interest rates. This made borrowing incredibly cheap, encouraging businesses and individuals to take on large amounts of debt to invest in assets like stocks and real estate. This influx of cheap credit fueled speculative investments, driving up asset prices beyond sustainable levels. Second, Japan's export-oriented economy benefited significantly from a weak yen, making Japanese goods more competitive in international markets. This led to a surge in corporate profits, further fueling the stock market rally. Companies, flush with cash, sought new investment opportunities, often venturing into real estate and other speculative assets. This, in turn, created a feedback loop, with rising asset prices encouraging further borrowing and investment, inflating the bubble even more. The Bank of Japan's monetary policy played a crucial role in the formation and eventual burst of the asset bubble. In the early 1980s, the central bank maintained a loose monetary policy, keeping interest rates low to stimulate economic growth. While this policy initially contributed to Japan's economic success, it also sowed the seeds of the bubble. Low interest rates made borrowing extremely attractive, leading to a surge in credit-fueled speculation. As asset prices soared, driven by excessive borrowing, the Bank of Japan faced a dilemma. Raising interest rates to curb speculation risked triggering a stock market crash and potentially derailing the economic boom. However, maintaining low interest rates would only further inflate the bubble, increasing the risk of a more severe economic downturn in the future. The central bank ultimately chose to maintain its loose monetary policy for an extended period, contributing to the unsustainable growth of the asset bubble. By the late 1980s, Japan's asset bubble had reached dizzying heights, fueled by speculative investments and easy credit. The Nikkei stock index, a key indicator of the Japanese stock market's performance, peaked at a staggering 38,915 points on December 29, 1989, marking an unprecedented high. Real estate prices in major cities like Tokyo had become astronomical, with some estimates suggesting that the Imperial Palace grounds were worth more than all the real estate in California combined. This was a clear sign of the bubble's extreme nature. This period of extreme asset inflation was characterized by a pervasive sense of euphoria and invincibility, with many believing that the bubble would last forever. The atmosphere was one of unbridled optimism. However, the bubble's unsustainable nature meant that a correction was inevitable. The signs of an impending crash were becoming increasingly apparent. The tipping point came in 1989 when the Bank of Japan, finally recognizing the risks posed by the runaway asset inflation, began raising interest rates. This move was seen as a necessary step to prevent further economic instability. This move, intended to cool down the overheated economy, pricked the asset bubble, leading to a rapid decline in asset prices. As borrowing costs rose, investors began to reassess the true value of their holdings, realizing that asset prices had become detached from economic fundamentals. The market correction was swift and severe, leaving many in financial distress. The Bank of Japan's decision to raise interest rates in 1989 marked the beginning of the end for Japan's asset bubble. This move was intended to curb the rampant speculation and overheating economy, but it had far-reaching consequences. As borrowing costs increased, investors' appetite for risk diminished, leading to a decline in demand for stocks and real estate. The once booming markets began to cool off, and the exuberance that had characterized the bubble years started to fade. This triggered a chain reaction, with falling asset prices forcing over-leveraged investors to sell their holdings, further depressing the market. panic set in as more and more investors rushed to liquidate their assets, creating a downward spiral. The Nikkei index, which had reached its peak in December 1989, began a precipitous decline, losing over 60% of its value in the following years. This dramatic fall shattered investor confidence and sent shockwaves through the financial system. The collapse of the asset bubble had a devastating impact on Japan's financial system. Banks, which had been heavily involved in speculative lending, found themselves in deep trouble. Banks, heavily exposed to the real estate market through loans to businesses and individuals, faced a surge in bad loans as borrowers defaulted on their debt. The financial institutions struggled to stay afloat amidst the growing number of non-performing loans. This banking crisis further exacerbated the economic downturn, as banks became reluctant to lend, choking off credit to businesses and consumers. The lack of available credit stifled economic activity and growth. The Japanese economy, which had enjoyed years of unprecedented growth, entered a prolonged period of stagnation and deflation, now known as the Lost Decade. This era left a lasting impact on Japan's economic landscape and serves as a cautionary tale for other nations. The bursting of Japan's asset bubble ushered in a period of economic stagnation and deflation known as the Lost Decade, which extended well beyond the 1990s. The collapse of asset prices wiped out trillions of dollars in household wealth, leading to a sharp decline in consumer spending. Businesses, faced with shrinking demand and a credit crunch, cut back on investment and production, resulting in job losses and further economic contraction. Japan's once booming economy had ground to a halt. The government and central banks struggled to find effective measures to revive the economy. One of the most challenging aspects of Japan's economic woes was the emergence of deflation, a sustained period of falling prices. Deflation, while seemingly beneficial to consumers, creates a vicious cycle in the economy. As prices fall, consumers delay purchases, anticipating further price drops. This decline in demand forces businesses to lower prices further to attract customers, leading to lower profits, wage cuts, and job losses. This deflationary spiral proved difficult to break, trapping Japan in a prolonged period of economic stagnation. The effects of this period are still felt in Japan's economy today, influencing policy decisions and economic strategies. Japan's policymakers struggled to cope with the aftermath of the asset bubble collapse. Initial attempts to stimulate the economy through traditional monetary policy, such as lowering interest rates, proved largely ineffective in the face of deflation and a debt overhang. The government also implemented several fiscal stimulus packages, increasing public spending on infrastructure projects and other initiatives to boost demand. However, these measures, while providing some temporary relief, failed to address the underlying structural problems plaguing the Japanese economy. One factor contributing to Japan's prolonged economic slump was the government's reluctance to address the issue of zombie companies, heavily indebted businesses kept afloat by bank lending, but with little prospect of recovery. These zombie companies, fearful of bankruptcy, hoarded cash and avoided making necessary investments, acting as a drag on economic growth. Policymakers' hesitation to allow these companies to fail, fearing the social and economic consequences, prolonged the pain and delayed the necessary restructuring of the economy. Japan's experience with its asset bubble and the subsequent lost decade offers valuable lessons for policymakers and investors worldwide. First, it highlights the dangers of excessive credit growth and asset price inflation. Maintaining price stability and financial stability should be paramount for central banks, even if it means sacrificing some short-term economic growth. Second, it underscores the importance of addressing asset bubbles early on, as delaying action only increases the eventual economic costs. Moreover, Japan's experience demonstrates the limitations of traditional monetary and fiscal policies in combating deflation and a balance sheet recession, where both the private and public sectors are deleveraging. It suggests the need for unconventional policy measures such as quantitative easing and debt restructuring to address these unique economic challenges. Finally, Japan's experience highlights the importance of structural reforms to enhance productivity, innovation, and long-term economic growth. The lessons from Japan's asset bubble remain strikingly relevant in the modern world. The global financial crisis of 2008 to 2009, triggered by a collapse in the U.S. housing market, shared many similarities with Japan's experience, highlighting the interconnectedness of global financial markets and the risks posed by asset bubbles. The unprecedented monetary policy responses to the global financial crisis, such as quantitative easing and near-zero interest rates, have raised concerns about potential asset bubbles in other parts of the world. Understanding the factors that contributed to Japan's asset bubble, the policy missteps that exacerbated its impact, and the long-term consequences of the lost decade is crucial for policymakers, investors, and economists alike. By learning from the mistakes of the past, we can hope to prevent similar economic disasters in the future and foster a more stable and sustainable global economy.